Patrick, tell me the difference between a bridge loan versus a typical conventional loan that we hear about.
Well, a bridge loan versus a conventional loan, everyone, or not everyone, but most people have gone and borrowed money from a bank. When you borrow money from a bank, the thing that I've always found interesting about banks is that they want to loan you money when you don't need it. But when you do need the money, then they make you jump through all of these hoops, kind of like a trained dog, that's in a circus to get money from them. What we do, instead of coming back and going through all the documentation that it takes to make a loan done through the bank and finding out what your credit history is and how long you've been at your job and talking to your neighbors and everybody else to find out if you're a good guy, we make we make loans based on the asset that we're looking at loaning money on. If the asset, we can ascertain in our minds that it has value, and we know what that value is because we've been in the real estate business for a long time, we loan money based on what that asset is, not your ability to repay, not your ability to have good credit, not your job status or anything else. We're making a loan based on the asset class and what the asset is, knowing that you're going to have an incentive to get the project done because you're paying a higher interest rate with us on a hard money or a bridge loan. Conventional is going to be a little bit cheaper than us, but it's also going to be much, much, much slower. And on top of that, you're not going to be able to get things as far as how we would work with you to make a deal would go. Banks do everything inside of a box. Conventional loans fall inside of these parameters. I want to buy a house. Well, is it going to be more than 28% of your income? We don't care about things like that. We want to know what the asset is and how much money is going into the asset to reduce our exposure.
Thanks for telling me.
You're welcome.